Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On May 30th, Fidelity Investments Canada hosted Focus 2024 Vancouver, a day-long event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. For today's podcast, we'll listen in on Reetu Kumra's Focus session. Reetu is Director of Research and Portfolio Manager of Fidelity Canadian Long-Short Alternative Fund. We'll hear from Reetu about the Fidelity Alternatives lineup and the strategy and research behind these funds. Specifically for Canadian Long-Short Alternative, the fund builds on Fidelity's historical track record of fundamental research in Canadian equities. Also, holding both long and short positions offers a different way to invest for Canadian equities and have the potential to benefit from both rising and falling prices of securities. This podcast was recorded on May 30th, 2024.
Reetu, welcome to the stage.
Thank you for having me.
Excited about this. So, you're a familiar face to some in the room, but not to all. So I thought I'd start by saying you've been with Fidelity 12 years, and maybe if you could take a few minutes to tell us a little bit about yourself.
Yeah, sure. So my name is Reetu Kumra. I'm the Director of Research for the Canadian Equity Research Team. I'm also a Portfolio Manager here at Fidelity. I joined Fidelity back in 2012. So I've been here for about 12 years. I spent a number of those years going through the analyst rotational program, so covering a variety of sectors throughout the TSX. A few years ago, I got involved in some of the crypto initiatives that we have in place through the Fidelity Advantage Bitcoin and Ether ETFs. And more recently, I got involved with portfolio management of the fund that we're here to speak about today, which is the Fidelity Canadian Long-Short Alternative Fund. So I have two roles right now at Fidelity. Within the Director of Research role, my role entails managing, mentoring, and growing the Canadian research team. And then within the portfolio management role, it involves the management of the funds that we just mentioned.
Great. So speaking about the Canadian Long-Short Fund, I thought I'd start by talking about the idea generation. We've talked about that today a few times. And we used to show the scissor chart. We called it the scissor chart. And it would basically show how well our buys did versus our sells. And every time we showed this chart, people said, you have to launch a fund like that. You've got to buy the buys and you've got to sell the sells or short the sells. And anyways, that's basically how this idea came into creation. So why don't you tell us about it?
Sure. So just taking a step back as to what this fund is, it's a 130-30 long-short fund that really allows fund holders to own the breadth and the depth of our research capabilities. And behind that research is what I think are our competitive advantages from a research standpoint, which are investment professionals, our research process, as well as the Fidelity scale. So what we did is we went back into time. Back in 2019, we did a study, and we did this alongside our head of our risk group, John Wilson. And we took a look at all of the data that we have in-house. And so this dates back to 2006. And we wanted to understand any sort of insights, any sort of conclusions that we can glean from all of this data that we have with regards to our research process. And a number of conclusions came from slicing and dicing this data. But ones relevant to this product would be that we do an exceptional job at really identifying securities that outperform the market. So that would be our buy-rated names. But what's really interesting is that we actually do an even better job of identifying securities that underperform the market, so our sell-rated names. And if you look over time, we do this with remarkable accuracy as well as consistency. So in 2020, that kind of led to the idea of, okay, so how about being able to package this into a fund such that we can go long on our buy-rated names and go short on our sell-rated names and really capture the true excess returns being generated from our research. And then overlaying this, the thought was to put a rules-based approach together such that we can maximize these returns being generated from our research, but manage our risk so that we can just deliver a very consistent, consistent portfolio such that it has really consistent return and risk metrics over time. So the strategy was launched in 2020, and basically it's really the genesis of this is the scissors chart.
Mm-hmm. Great. So how is it different from a cap-weighted product like an SMA or an ETF?
So I think there are a few key differences. Starting off, to our knowledge, we have the largest research team covering Canadian securities in Canada. And so day in and day out, we have our team really looking at every single thesis that we have under coverage in Canada. And each one of these positions are represented in some way in this fund. So this fund really leverages that research platform that we have. So that's one key difference. The other key difference is this is really an all ideas fund as opposed to just a concentrated best ideas fund. So that in that way, I think it would differ from an SMA. We have the capabilities of going short in this fund, and so you don't necessarily get that from either a passive ETF or an SMA. And because we're really trying to capture that accuracy and the consistency of our research, we do attempt to have an equal representation both on the long side and the short side of the fund. And so as a result, there is a smaller cap tilt to this product.
Okay, great. What is the rationale behind having it in a portfolio? And we had the GAA group up here earlier today saying that they've just invested into 3 of our long-short funds, and actually Canadian long-short will be the next. So if you could talk to at least your opinion on where you think it adds to the portfolio.
Yeah, so I think this is considered an alternative fund because we do have shorting capabilities. But the way I'd actually think about it is that it's just a core Canadian diversified fund that just offers directional exposure to that of the market while capturing these excess returns being generated from the long side with our buy rated names as well as the short side with our sell rated names, and really offering the consistency, the repeatability, as well as the accuracy of our research process. So I'd really categorize this as more of a returns enhancer. Mm-hmm. And I do think that this year in particular, is a year where it's a stock picking year. We've had some years in the recent past where, it's been all about the macro and what rates are doing, liquidity. But I really truly believe that this year is a year for stock picking, and that's exactly what this fund does.
And why would someone purchase this over just getting a low-cost ETF, getting broad-based market exposure?
Yeah, so I think it comes down to what we spoke about. So this fund will offer access to our research platform, and that too across our buy rated names as well as our sell rated names. It offers shorting capabilities as well, and it really offers. It basically is this all ideas fund that has an equal weighted representation of every single security that we cover in Canada.
And so what are you looking for when if you could give a few examples, what you're looking for when you're purchasing a company or shorting? I think you've got a couple of examples of each.
Yeah. So Fairfax Financial, that was that is an idea that is in the insurance space. And so we have a fairly new analyst that's joined us about 2 years ago. His name is Connor McGrath. He joined us straight from school, from Wilfrid Laurier, and he has been a phenomenal asset to the team. And so he's on his first assignment. He covers real estate as well as insurance companies. And when he was looking at Fairfax back in 2022, to give you a little bit of a history for those of you who aren't as familiar with the name, Fairfax has been a public company on the TSX for decades, and it's basically a conglomerate. It's an insurance company. And so it has really 2 sides of the business. It has its insurance business. So it offers commercial insurance and underwriting. And then it takes the premiums that it gets from customers and invests it. So this stock had completely derated over the past 10 to 15 years. And the reason for that was that it really, on the insurance side of the book, its underwriting wasn't very good. The insurance business didn't necessarily go through a pricing cycle, and so the earnings power derated on the insurance side of the book. On the investment side of the book, it didn't do well because they made some very aggressive investment decisions, such as betting against the market, so shorting the market during the bull market of the 2010s. They also bet on 1930s style deflation in the last 10 years, which of course did not transpire. And so the stock really derated. And when he started taking a look at this one, it was trading at 0.8 times price to book. So he took a look at this and he took a look at this from a different lens. And he saw a business that was about to embark on a pricing cycle. So these insurance companies started getting pricing. I'm sure all of you in the room who have renewed their insurance in the recent past, you can see the premiums are going up. They started doing better from an underwriting perspective because he went through this in-depth analysis on their reserves and saw that the insurance business was actually capturing more earnings power than the market was actually expecting. And then on the investment side of the book, it was sitting on a lot of cash. And if you recall back in 2022, interest rates started going up. And so it had the ability to start deploying that capital in a very quick fashion and increase the earnings power. So at 0.8 times book, the market was baking in an ROE of this business of being, mid to high single digits when he saw the earnings power resulting in an ROE of mid-teens. Mm-hmm. So he put a buy on the stock, and we initiated a position in the fund, and it's been a great contributor. So you can see that it's since about 6 months ago. It has from the time that he had put a buy on the stock till about 6 months ago, it contributed roughly 74 basis points to the fund. And I think that when he was looking at the setup of the fund, of course, he's a new analyst coming to Fidelity straight out of school. And what helped him was a few things. One, if you take a look at the institutional knowledge on our team, it's actually quite amazing. So every single person that's been covering this stock since 2006 is still on the team. So he had a lot in the way of resources to actually lean on. Two, because we do have specialists on our team, he was able to dig into those reserves and really understand what was going on with the underwriting of this business. And then three, I think that, just having the ability to talk to his fixed income counterparts, talk to the traders, talk to all the resources around him just really helped in his investment process. And so that's an example of a long position that really benefited the fund.
Great. And I think your next example is actually on a short. So we've got the next slide.
Yes. So on the short side is a Canadian telco company, which shall remain nameless. And so this position, we put a short on it also in 2022. And this was more driven by industry headwinds. And so back in 2022, when our analyst was taking a look at the stock, he saw a situation such that we had interest rates rising. So that's not necessarily good for interest rate sensitives. He saw industry headwinds because there was big M&A that happened in the wireless space, introducing a potential fourth player into an oligopoly within the telcos. And then he saw increased regulatory burden. And so while he was seeing these headwinds from a fundamentals perspective, this stock, the valuation just kept going up. And so if you recall, in the spring of 2022, it was very much a risk-off market, just given the geopolitical conflicts that existed across the globe. And so there was a flight to safety, which benefited the interest rate sensitives and the defensive stocks like this telco. And so while the valuation was going north, the fundamentals were going south. And our analyst he just really he leaned on the team, he leaned on our history of notes, he leaned on looking at the valuation over various cycles, and he realized this is as good as it gets. And so he put a sell on the stock, and it was an excellent contributor to the fund at about roughly 30 basis points. And so if you think back to 2012, when the market was so risk off, we were selling interest rate sensitive, so in a telco, and we're buying companies like Fairfax, which had been an underperformer for a decade. And while that feels like something that you wouldn't necessarily want to do in a risk-off environment, that was just the power of our research and our stock picking coming through, because that was absolutely the right thing to do.
Yeah. So, question from the audience: how do you size your positions on both the long and the short?
Yeah, so that's a really good question. So what we try to do is, the purpose of this fund is to generate the alpha within the super sectors. So the super sectors being our interest rate sensitives, resources, industrials, as well as consumer. And so what we try to do is we try to keep it roughly equal weighted both on the long side of the fund as well as the short side of the fund within the context of those super sectors, and generate the alpha really truly from the research.
Okay. And speaking of research, this really is a research-driven strategy. So what gives Fidelity a competitive advantage here? And obviously being director of research, tremendous amount of talent on that team. And Hugo talked about it this morning. He talked about how hard it is to get into the team. And I think he said for your most recent role, I can't remember how many resumes you said came in for it, but tremendous amount of interest getting into the team. But talk about why Fidelity does this well, this type of strategy well.
Yes. So I mentioned what I think our competitive advantages are. So it's our investment professionals who drive the research and use the Fidelity scale to do it. So it's those three competitive advantages. So you're right. So what Hugo was talking about this morning, so we sifted through 3,000 resumes to hire one person that was just hired back in October. And that's very typical. And so we're really just looking for the best of the best for the team. And so what I think is really interesting is, just from an investment professional standpoint, is that we actually, since I've been with the firm, which is February of 2012, no one has left. And so that just speaks to, first of all, the culture, but also it speaks to having that institutional knowledge and that consistency on the team, which came through in the examples that I just walked through. And so every single research analyst will go through a rotational program, and they are being mentored by all of us, all of PMs on the team who have gone through that process as well. And so having the research professionals do this day in and day out and really contribute to every single position in the fund is a very big competitive advantage. When I think about the actual research process, I keep talking about the research process, but what exactly is that research process? It involves these analysts coming in and day out and just really focusing on creating alpha for the fund holders. So that might mean looking at industry drivers, looking at companies or stock specific drivers, financial modeling, looking at upside or downside scenarios, looking at dissecting balance sheets, looking at valuation. And they do this by using that Fidelity scale. And it might mean that in order to kind of drive these estimates and drive the understanding of how these stocks are going to behave, it might mean talking to management, whether it's at the C-suite or middle management. It might be talking to buyers, suppliers, competitors, going to industry conferences, or we just had a group that was out in the Permian, our oil analysts, our energy analysts were out in the Permian last week, just looking at how do you extract oil from the ground, and talking to people down there and understanding kind of the competitive advantages across these companies. And so there's a lot that goes in and day out into this research, which actually drives every single position in the fund.
And I've heard stories in the past from some portfolio managers that we just get access. During a time of crisis, we can pick up the phone and meet company management. Did you have any stories about that?
Yeah, actually, we had. I have so many stories. We have such a great relationship with our management teams, and that's not necessarily just from the group of analysts that we have right now, but it's also just the PMs and the analysts that have covered these stocks over the past several decades. And so the one story that comes to mind is it was a couple of years ago where there was a management change, so a surprise CFO change at one of the big six banks. And our analysts at the time, the press release went out at 7:30, and by 8 o'clock, the CEO of this big six bank was calling our analyst on his cell phone, explaining why this is actually not that much of a surprise, the history behind this move in management, and why this is okay, and why the strategy won't change. And so we were one of the first phone calls that actually went out to investors. And what that allows us to do is, first of all, having that corporate relationship is good, because we were one of the first ones to get that call and to be able to synthesize the information that we were learning well before market open to see whether it was a thesis changing event or not. And because we have that kind of a relationship with so many of our management teams, that's a very, very common example.
Okay. Canada. We've heard a lot about Canada today and the prospects. And, there's the opinion of some that, it's going to be a tough year. Why Canada for this product?
So I think there's a couple of ways to look at it. One, Canada is our home market. We have the data that I talked about where we've back tested this product. We have the most robust data set for the Canadian product. But I think this product is less about the country per se and more about the research. And so there's different opinions about where Canada stands relative to the rest of the world, where it stands relative to the US. And I think that through the cycle, you're going to have situations such that Canada outperforms the US or the globe, and there's going to be times where Canada underperforms. And the idea behind this product is not necessarily about Canada, but when you do have that outperformance, to widen that performance gap between the rest of the world and Canada, or even the US and Canada. And when Canada is underperforming, to narrow that gap through the alpha being generated from the fund. But specific to your question on Canada, I think that there's a number of there are a number of questions about what's happening in Canada. We heard some of it today. There are tailwinds and there are headwinds. Of course, the tailwinds being, we are a resource-based economy, and we've seen what's happened with commodities, which is a benefit to the Canadian economy. But the headwinds being what we heard earlier today. We do have the leverage of the consumer. The mortgage market here in Canada is very different from that of the US. And so we do have a wall of maturities happening. An interesting fact that when we talk to our CEOs of banks, that we've learned is that if we're to market what the interest rates are today relative to where mortgage rates are, it would impact discretionary spending for the average household by between 10 and 15%. So of course, no one's going to necessarily not pay their mortgage, but the question is, where does that come from? Where does that budget come from? And those are the kind of things that we're thinking about. So we do have a concern about the consumer. Productivity, both the Davids and Alon spoke about this earlier. From a productivity perspective, we have been investing in housing here in Canada over a business investment, and so we don't necessarily have that productivity gain that the US has, which is something to be considering from a headwind perspective. And then you're just slowly seeing unemployment inch up, and so those are definitely headwinds. But I think as you compare Canada to, say, for example, the US, it's about what the market's actually anticipating as well, and what valuations are anticipating. So the Canadian market is trading at roughly 15 times for what's expected to be about 7% growth next year or this year. And then the US market is low single digits expected growth, and is trading at roughly 21 times. And of course, it's not an apples to apples comparison, because there's a bit of a mix factor there, as we talked about earlier with the Mag 7. But in the Canadian market, there's always opportunities, and that's exactly what this fund is striving to do, to find those pockets of opportunities within the market of stocks.
So with that backdrop then, how is the fund positioned, and are there any themes?
Right. So I think from a positioning standpoint, I think it's important to be thinking about this from the position of super sectors. And so, as I mentioned, the focus is to drive the alpha within the super sectors, which again are our interest rate sensitives, our resources, our consumer super sectors, as well as the industrials. And so, from an interest rate sensitive standpoint, the way the fund is positioned is, of course, we've seen tremendous valuation pressure across interest rate sensitives, given what rates have been doing over the past couple of years. But within that, we find that utilities and power names are actually quite interesting. And so, if you think about these businesses, they're mid-single-digit EPS growers. Interest rates aren't as much of an impact from a earnings standpoint because they're typically passed through to the customer. Valuations are pretty attractive, mid-teens PE. And then you have like the data center AI kicker where, there's been a theme out there that we're going to have to really build out the grid. We're going to need more power. And so you have that optionality on these stocks. There's select opportunities in the financials where it's more the high quality financials, some of the insurance names. We talked about Fairfax earlier as a historical position. And some select telcos, given the pressure that we've seen on valuations within telcos. And this is coming at the expense of the banks. And so from a resources standpoint, we tend to like the base metals and precious metals. Hugo's been chatting a lot recently about copper. And so copper is a commodity that we like. Typically within the resources, we're looking for either a demand catalyst, a supply catalyst, or a valuation catalyst. So whether it's copper or lumber, precious metals, those are the commodities that the fund is positioned with, and that comes at the expense of energy. With energy, I think we're more range bound on the commodity. I think there's some benefits in Canada with egress coming through between TMX oil pipeline as well as LNG Canada, but again, it comes back to the valuation and what these stocks are baking in. And then within industrials and consumer, those are the stock picking sectors. And so there's always pockets of opportunity within those sectors. I think consumer discretionary, given concerns about the consumer, have really been beaten down recently. So that's been an interesting area to fish through. And then Hugo again talked this morning about transports, and so that's an interesting area. But those are the sectors where the themes can really can really emerge, whether it's decarbonization, AI, data centers, just through those types of stocks.
And will the fund at all exhibit any factor or style biases naturally?
So the only real factor that we've seen emerge over the time has been the small cap tilt that I mentioned earlier. So if you think about our research, this fund is really predicated on our research platform, and this research platform serves the broader Fidelity fund platform, and so there's no intended bias with the research, and so any given if we have a rating on a value stock, it's not going to be predicated on it being a value stock or it being a growth stock. It's going to try to serve the entire spectrum of PMs. And so there hasn't been a bias that's emerged other than that small cap bias.
We had a question came in when you were talking about the markets in Canada. So how is the fund structured to effectively navigate these conditions?
So again, I think this there are headwinds, but I think within headwinds and within the tailwinds that we spoke about in Canada, I think it really just comes down to the stock picking capabilities. If I actually were to take a step back and think about the types of, I talked about the broader positioning from a sector standpoint, but if I actually think about the types of stocks or the categories of stocks that exist in this fund, I would say we have through the cycle compounders, which tend to work through the cycle, provided that we don't see any sort of earnings downside. So we're again very focused on earnings. We have those late cycle defensives. So those are the names like the interest rate sensitives that I spoke about earlier. And then we also have names that have just been completely beaten down. And so those names that are more contrarian in nature and such that if we just have a little bit of if we can extend our time horizon a little bit, we'll get the earnings power coming back as well as the valuation. And so I do think that we are in the late cycle of the economic cycle, but I do think that the late cycle can last a long time. And so that's why I think it's important to stock pick our way through this kind of environment. And with the uncertainty of what's happening in the economy and in the market comes opportunity.
Okay. And can you give an example of a day in the life of an analyst? I've had a lot of questions actually in the hallway. Just, what does an analyst look like? What do they do when they come into the office? You've mentioned they do a lot of company meetings. How many would they do in a day?
Oh my gosh. So we have, I feel as though we are always double or triple booked because there's so many analysts hosting so many meetings at any given time. And even if it's not a Canadian meeting, maybe it's a US peer or maybe it's a global peer. And so there are meetings every half hour. And so in terms of the day in the life of, I can't say that there is a typical day in the life of. There could be a day where an analyst is coming in and dealing with 5 companies that reported quarterly earnings. There could be a day where they're meeting 10 management teams at an industry conference. They could be out on a mine tour in northern Canada. Or they could just be, it could be a quiet day where they're just looking for new ideas for our fund holders to own. So there's no real day in the life of, and I think that that's what makes what we do so dynamic and interesting. But ultimately, the end goal is always the same, and they're always trying to do the same type of analysis, which is what I spoke about earlier.
And we've talked a lot about the team, and some names have come up today. One of them is John Wilson, who's head of risk on the team. What risk management processes do we have in place when we're thinking about shorting the securities?
So I think that's a really important question, just given the short component of the book. And so there are a number of things that we do to make sure that the risk is being appropriately managed. One, we have a very diversified fund. And so it has between 120 to 190 positions at any given time. And within that, between 40 and 80 positions at any given time will be on the short side of the book. So again, that 30% of the gross 160 exposure. So it's very, very diversified. Number 2, we have a focus on cost of borrow. And so that's indicative of the short interest that exists in the stock. And so if the cost of borrow goes too high, we'll automatically close the position. We're very focused on just the position size. And so if we find with market drift that a position size runs away from what we want it to be, then we will quickly ratchet it back because we're constantly rebalancing this fund. And just from a process standpoint, every quarter we have quarterly risk reviews, and it's this 75-page document that we comb through on a quarterly basis to ensure that the fund is doing what it's intended to do or what it's supposed to do. We get weekly risk reports. And, if, for example, there's something happening in the market and I'm not at my computer like right now, there's a process in place such that emails get sent saying, there's extreme volatility in this stock. Okay, this stock just breached, the intended position. So there's processes in place in order to manage that risk.
Yeah, Dan was talking about it earlier, how he gets alerts. He said about every half an hour. They're actually every 15 minutes on his shorts. So
yeah.
And then you talked about being super sector neutral, and why did we choose to do super sector instead of sector?
I think that with the super sectors, it allows us with a little more to have a little more flexibility in terms of the alpha generation. We've done a lot of back testing on this product, and the structure as it stands today was the best possible outcome without being too limited. Mm-hmm. And so in terms of the actual positioning, just having that, having the ability to go super sector neutral and focusing more on the super sectors was just allowed for more of an opportunity for alpha generation. And if you think about just, for example, with resources, even with sector neutral funds, many of the PMs are thinking about it from a resources perspective and not just copper versus gold versus lumber. The same thing with interest rate sensitives. And so this kind of gave us that flexibility that we needed.
Great. And how does your background in stats help you oversee the fund?
So actually, not many people know this, but I'm actually a statistician by training in a prior life. Feels like a while ago. And so just because we do have this rules-based approach, I work very closely with our team, so John Wilson's team, in order to manage this fund. And so it has it's fundamentally driven with a layer of this rules-based approach upon it. And so having that background just really lends itself to both my fundamental background as well as my stats background that I have.
So we're close to time. I'm going to leave you with the last question, which is, what can you leave us with today thinking about Canadian long short, if you had to give us your pitch on it?
Yeah, so again, I think this fund is it's a 100% Canadian, so it's a fund that really stays in its lane. 100% Canadian, long short, very diversified. It offers directional exposure to that of the market, as I mentioned, as it's tilted towards the super sectors. But it really allows fund holders to really grasp and own the broader spectrum of our Fidelity research platform. And that's through going long on our buy-rated names and going short on our sell-rated names to just really own what we think is one of our most valuable assets, which is the accuracy, the consistency, and the repeatability of our research.
Great. Thank you very much, Reetu.
Thank you.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.